Gold started breaking out, I think, February last year. We broke through that 2100 barrier in gold, and here we are almost at 3,000. I think it's going to take a little longer here for the CRB to actually break June 22 high, which was 330 or thereabouts. But I think we're going to have a major leg up, and I think we're just beginning this secular bull market in commodities. This is not going to be, it's going to be protracted. It's secular. And I think what it means, along with gold and silver moving higher, is that our currencies, our fiat currencies, are actually, they're beginning to show what they're really worth after years of central banking inflation.
Financial markets and macroeconomics analyst Mario Innecco emphasizes that the gold market has entered a phase of gold mania, characterized by unprecedented price surges and heightened volatility. Gold's meteoric rise to a record-breaking $2,954.69 per ounce on February 20, 2025, marks the 12th time it has reached new all-time highs this year. This relentless upward momentum suggests that investor demand remains strong, driven by economic instability, inflationary concerns, and geopolitical uncertainty. Innecco believes this is just the beginning, as the forces underpinning gold's ascent are persistent and intensifying. One of the key catalysts driving gold's surge is the ongoing geopolitical crisis in Ukraine, which continues to fuel investor anxiety. Since Russia's 2022 invasion, gold has been a primary refuge during the escalating conflict, and renewed instability in Eastern Europe, further exacerbated by recent statements from former U.S. President Donald Trump, has only heightened uncertainty. Investors are turning to gold as a safeguard against political and economic disruptions, a pattern seen throughout history during major crises. Alongside geopolitical concerns, inflationary pressures remain dominant in gold's rise. Trump's proposed economic policies, which include aggressive tariff measures and substantial fiscal spending, are widely expected to stoke inflation. In addition to investor demand, central banks worldwide have significantly increased their gold purchases, providing strong institutional support for rising prices. Since 2009, central banks have been net buyers of gold, a trend that has accelerated dramatically since 2022 as nations seek to diversify reserves away from the US dollar. China and India have been leading this movement, with China's gold reserves reaching a record $73.5 billion in January 2025, while India's reserves hit an all-time high of $70.9 billion in February 2025. This aggressive accumulation underscores a global shift toward hard assets, as countries hedge against economic instability and potential shifts in global financial power. With growing concerns over inflation, currency devaluation, and systemic risks in traditional financial markets, gold's role as a fundamental pillar of economic security appears stronger than ever. We present the clips of Mario's latest video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Back in 2020, we saw everything really crash. That was from January to like April of 2020. The stock market, gold, silver, the CRB index. Bonds, of course, were very volatile. They were up and down like a yo-yo, which isn't good either, because treasuries specifically are supposed to be as good, well, not as good as gold, but they're supposed to be very stable and risk-free, and they were anything but. And that's one of the reasons why Jay Powell had to start QE to stabilize the treasury market. But one thing that happened is that gold dropped from 1750 to 1450. It was very quick, and then it took off. And by by July or by the summer of 2020, the same year, gold was back towards 2000, while commodities lagged. And commodities only topped in June of 2022. So gold and silver, to some extent, led the way. And then commodities followed. But for the last 2.5 years or so, commodities have been consolidating in this pennant formation. As you can see here, this is the CRB index. It's a Commodities Research Bureau index. It's a collection of major commodities. It includes gold and silver as well. And I've been talking about this for the last few months, that it looked like we're going to break out of this consolidation. And usually these consolidations after a major leg up, they can either be, they can be 75% of the time very bullish, or 3 out of 4. Sometimes they fail and the market goes back down. And I think it's definitely breaking out here. And it's a little bit delayed, of course, compared to gold. Gold started breaking out, I think, February last year. We broke through that 2100 barrier in gold, and here we are almost at 3,000. So I think it's going to take a little longer here for the CRB to actually break the June 22 high, which was 330 or thereabouts. But I think we're going to have a major leg up, and I think we're just beginning this secular bull market in commodities. It's going to be protracted. It's secular. And I think what it means, along with gold and silver moving higher, is that our currencies, our fiat currencies, are actually, they're beginning to show what they're really worth after years of central banking inflation. And by inflation, I mean all the money printing and also the fiscal loose fiscal policy of the major countries. We're up to here in public debt. This is how the system rebalances itself. I think we are in the age of hard assets and tangible goods, commodities. It doesn't mean to say that stocks and bonds are going to disappear, but they're just going to underperform massively.
Recent market anomalies, including persistent London delivery delays, repeated record-breaking gold prices, and unusually large bullion transfers to U.S. vaults, have intensified speculation about a potential official revaluation of gold. Mario suggests that if the U.S. Treasury were to revise the valuation of its deep storage gold from the long-standing $42.22 per ounce, it would effectively devalue the dollar against gold, signaling a significant shift in monetary policy. Such a move would not only boost the U.S. government's fiscal position and borrowing capacity, but also serve as an implicit acknowledgement of the dollar's declining purchasing power. Historically, gold revaluations have often accompanied dollar devaluations as governments seek to stabilize financial systems amid inflationary pressures and mounting economic uncertainty. Given the ongoing concerns over U.S. debt levels, inflation, and global de-dollarization trends, many investors view gold as a reliable hedge against potential currency devaluation and financial instability. Gold has long been regarded as the ultimate safe haven asset, preserving wealth when fiat currencies lose value. Throughout history, during economic turbulence and policy shifts, gold has retained its purchasing power while paper currencies depreciated. If an official revaluation occurs, it would reinforce gold's role as a store of value, particularly as central banks worldwide continue increasing their gold reserves to reduce reliance on the US dollar. The potential for a dollar devaluation further strengthens the case for gold as a safeguard against eroding wealth, inflation, and economic volatility.
There's been such a huge bubble created in the paper market, in the 60-40 stocks and bonds, that even a small percentage of the money flowing to commodities is going to make it a huge, relatively speaking, outperforming market to stocks and bonds. And I told you in the beginning that I'd tell you what this means, this breakout in commodities, and that I'm going to refer to a pocketbook of gold by Jim Sinclair. He wrote it along with someone called Peter Carlin. And unfortunately, Jim Sinclair passed away, I think it was last year. And Jim Sinclair, I started following him in 2002 when I started when I started buying gold and looking into gold. He had a great blog called JS Mindset. So I have a lot to thank Jim Sinclair for. And it's a shame he's not here to see this bull market in gold. But he did see the one in the 70s though. Anyway, I want to talk about gold is a revealer of falsely stated wealth. It's on page 70, as you can see here. And it's tough to get this book, unfortunately. Someone asked me if I could copy it and put it in a PDF file, but that's not something that I do. This is copyright. You're just gonna have to search for it, and it's not gonna be cheap, unfortunately. So let's see what gold really tells us, and commodities as well for that matter. When wealth is overstated and expectations for future wealth are unrealistic, fiat currencies depreciate. Well, that's what we're seeing now. I think the jig is up for the falsely stated wealth camp. The depreciation is borne by the citizenry who are forced to lower their living standards to compensate for both personal economic mismanagement, well, taking on too much debt, not stacking enough, as well as the mismanagement of the affairs of states. Well, they're trying to fix that, but I think it's a little bit too late. Anyway, financial and military overextension has a social corollary in overpromised Social Security, Medicare, overstated real estate, equities, affluence. As expense runs out of control, guarantees to the citizenry also explode as politicians seek to retain the privilege of office. But the promises of wealth are false. The belief that ownership of real estate is a ticket to fortunes is hollowed out for what it is, a myth. And before I continue, just wanted to show you the chart of UK nationwide house price index to gold ratio. And notice how the top of that ratio was in 2004. So that's when houses were the most overvalued versus gold. And you can see that versus gold, UK house prices actually have not done well. Gold is a revealer of falsely stated wealth. So let's continue. Wealth that was taken for granted suddenly appears ephemeral. The amount of currency which once bought certain things no longer does, but wages have not risen along with prices. Well, we're seeing examples of the currency not buying what it used to.
Undoubtedly, the recent gold mania is fueled by a perfect storm of geopolitical tensions, economic instability, and aggressive central bank purchases. As uncertainty grips global markets, gold has re-emerged as the ultimate safe haven asset, with institutional and retail investors pouring in to hedge against inflation and currency devaluation. Analysts believe that with surging demand and eroding confidence in fiat currencies, gold reaching $5,000 per ounce is not just speculation, but a realistic possibility. The combination of rising debt, geopolitical conflicts, and concerns over monetary policy has created an environment where gold is a store of value and a crucial safeguard against financial turmoil. That's it for today. Share your thoughts on Mario's analysis of gold revaluation and price prediction in the comment section below. If you find this video informative, don't forget to support your finance log team and turn on notifications to stay informed about our latest videos. See you in the next video.